We would go into meetings like, hey, this is our thesis. 1% of funding at the time went to Black, Latino, and women. They represent 70% of the US population. Today, that 1% is at roughly 3 or 4%. We're like, hey, like this 1% is extremely focused and extremely niche. Like we don't want to be thesis driven within the 1%, right? And people would say, well, what's your thesis? We're like, well, this is our thesis. Our thesis is that diverse founders are going to outperform their 1% of the market. We're going to know this 1% better than anybody else.
Welcome to Entrepreneur's Handbook, where we share inspiring startup stories with practical takeaways for you, the listener. Today we have with us Henri Pierre-Jacques, who is the founder and managing partner of Harlem Capital. Say hi to everyone.
How's it going?
Harlem Capital has now grown massively, and you've got a huge fund that's doing really well helping diverse founders. But how did you get into this in the first place? Like, what made you go from your corporate career into starting your own fund?
Yeah, so it kind of happened by chance. I was working in private equity with my partner, Jared. We were actually CUBE mates, but we had known each other for about 8 years at that point. And, the stock market was down in December. And I turned to him, in the CUBE mate next to me, and I was like, hey, what if we started investing into companies like we do at work, but with our own money? I'm tired of losing money in the stock market and having no control. He said, sure, let's do it. I was like, let's just put in 10,000 each. I texted my roommate, who was Brandon at the time, who's one of our partners at the firm now. Jared texted his roommate. Within 30 minutes, we had, $60,000 across 6 guys. And then we met in Jared's living room 2 weeks later. We did that for about 2.5 years, deployed about $250,000 of capital. So way more than the initial 50 we thought. We really realized we loved investing. Fast forward 2.5 years, Jared and I started Harvard Business School. We're roommates. Start recruiting. We had worked at a Black-owned private equity firm, and we had mostly invested into people of color during the angel syndicate, even though we weren't diversity focused. And so really, I didn't want to work for a firm that didn't have partners of color and wasn't investing in founders of color, which essentially was 99.9% of all firms. And so, I turned to Jared again, but in our kitchen, and said, hey, instead of recruiting, why don't we use our angel track record and start a fund? Right. And so June of 2018, which was between our first and second year of business school, we formally launched a fund, and we've been, doing this for the last 4.5 years since, but really wasn't the plan. Didn't enter business school thinking I was going to raise a fund, but I think it just kind of, happened over time.
And what's nice about that as well is you've started this with your friends as well. And how has that process been? Because a lot of people struggle to find co-founders or people to come on that journey with them. Did you find it quite easy to split their roles up, or how did that process go?
So definitely a lot of people thought it was a risk. They're like, oh, and these are my best friends. I lived with Jared for, 2 years in business school. I lived with Brandon for 4 years in investment banking. So these are my best friends. And so there definitely was some concern. I think we just always really realized hey, we're going to be brothers first. And we respect each other. We trust each other. And no matter what, no matter if we're critiquing each other, no matter if things, get heated, because when we were angel investing, these were 10, 20K checks. These are a lot of money for us as 25-year-olds. So things definitely got heated, but it was hey, we can always leave that meeting, go to dinner, and then go out together in New York City. Right. So I think just staying grounded, kind of creating those boundaries, has kept us working together for the past, 6 years. But there definitely was some risk, but I honestly wouldn't change it for the world. People are always do you love what you do? I'm I love what I do because I work with the people I love. I'm doing what I love for the community I love, which is diverse founders. And so I feel really fortunate to kind of have this trifecta in my job and career, and I wouldn't change it for the world.
And how did you guys decide on that first angel investment? Was it something you did quite quickly after deciding you're going to do these investments, or did it take a long time to pick that first one?
So we met December of 2015. I want to say our first investment was March of 2016. Which wasn't actually a tech investment. It was into a coffee shop called Harlem Coffee. And that investment, we actually 1 or 2 of the 6 of my friends ended up leaving the syndicate because of that investment. Because they were we only want to do tech startups. And we were oh, well, we want to just invest in great companies. And we love the idea of we all live in Harlem. Our first investment is Harlem Coffee. There weren't many Black-owned coffee shops in Harlem, let alone coffee shops, period. And we thought it was essential. And so we knew it wasn't going to be a massive, 5, 10X. But I think for us, it was just the symbolism of it, Harlem Capital investing in Harlem Coffee. We had a place we can go to. So we used to host founders there. I remember we had our first Google event there, right? And so that was really cool for us. And it's funny because over time, we kind of switched and said, okay, we're going to only do venture. And then our friend who left was like, "Dang, I wish you guys made this decision, 2, 3 years ago." But like, at first it was just like we loved investing. So we invested in a dentist office in Harlem. We invested in 2 real estate properties, and then we invested in 6 startups. So we were just investing. I think it was just like we have a passion for investing, and we weren't sold on any asset class. And over time, it became okay. We like venture of these 3 asset classes. Within venture, it was pretty clear like we like investing in people who look like us, right? And it's like that progressed over like a 3 year period. But like to start, it was like we invest in anybody, we invest in any asset class. We just like want to deploy capital and learn and meet really smart people.
Yeah, and like having that base with Harlem Coffee as well, did that help in some ways? Because you had that place where everybody could come to see you, and you're in the community itself as well, right? Because let's say you decided to have an office like in the city or away from everything, you might not have had that same opportunity to like really be on the ground if you moved away or went somewhere else. But being part of the community, right?
So our office was at the Harlem WeWork, probably 7 blocks north of the coffee shop. And it was nice. I mean, like if I had friends would come up to Harlem, because a lot of people in New York don't go to Harlem because it's north. And so I would have friends like in South Manhattan, like come up to Harlem just to check out the coffee shop. Right. So it was a way to like pull in people also, like bring them to the community. And so I think like that was just like, even we actually ended up closing the coffee shop during COVID, unfortunately. But I think just like the experience of going through that process, it also taught me like I don't like small business investing. It's really hard, right? Like we were in the coffee shop, like while I was getting bills, and we're figuring out where do the plugs go, where's the counter going to be positioned, how long should people have Wi-Fi access so they're not sitting down for too long before ordering something new. Like all of these nuances, like I think showed me like one, like small business is really hard. So I'm empathetic to people who do it, and like when I see restaurants like Tao or whatever be around for 5, 10 years, like it's very impressive. Right. But it also taught me like, even though I'm empathetic, like it's not for me worth my time to be like in this much of weeds doing this much work day to day for the capital that could be returned, on a 3 to 5 year period. And so I think it was a great experience and a cheap way to learn that lesson versus like learning that lesson later on, making a massive investment in some restaurant, that I liked or a friend was starting. And so I think I learned that lesson early.
Yeah. And it's interesting what you said there as well, because I think sometimes people in the tech world might look down on the small business owners, right? The people who start restaurants or coffee shops, but they're really hard, as you said, and there's such a high failure rate because it's such a difficult business and there's so much competition. And it's like, how do you stand out in that market? And like from that experience, like if somebody was like listening now and they said, they know it's hard to start a small business, they know it's hard to make sure a small business works, but what advice would you give them if they were looking to invest in a small business? What should they look out for? What are some of the red flags maybe you missed or you wish you knew before?
Yeah, I mean, lessons we learned, it takes way longer to open an SMB than you ever imagine. I even have a friend who launched a restaurant in Detroit, which is where I'm from, and he probably opened the restaurant 9 months, 12 months after, right? So like one, you've got the contracting side because there's a physical location. So, and especially now in today's market, right, with contractors just being over demanded, you're going to have delays on the contracting side. Then once you get to that, you're going to have backups on the licensing side because all the cities are understaffed. And so like you got to get licenses for electricity, then plumbing, then yada, yada, sidewalk. And it's like the steps they have to take because if one person gets delayed, it delays the entire process. So I think like we really underestimated that. Like that wasn't built into the model. Like we wanted to open the coffee shop in the summer. We ended up opening up in February, which is like, you don't want to open a coffee shop when it's snowing outside of New York, right? Like, it's like that, like that didn't help. And so I think just understanding that, I think from a financing perspective, right, the coffee shop cost us roughly probably $500K to open. I think he did like $300K of debt, $200K of equity. It's a much different financing landscape for small businesses than venture. And so it's a lot harder because there's just only so many places you can go to get capital to open the place. And the more your own money you put up, like, yes, you will own more of the business, but also there's more at risk. Right. And so when there's like, hey, like I have I think in New York, the average restaurant lasts 3 to 5 years. Right. So like if you have like that high of a failure rate, like you don't want to put like your life savings into that restaurant from like a risk reward perspective. But a lot of entrepreneurs are forced to because like there's just only, there's such limited financing options for small businesses because a lot of funds like myself, like we don't invest in small business because the upside's not there. So that's really hard. I learned that like there's a much higher bar for like a capital perspective, which almost makes it riskier than venture because like the founders aren't putting up generally any capital, if not like much at all when they're, raising venture capital. So those are like the two biggest ones. But I think it's just like you have to really know that like you're gonna be working a lot of hours, and unlike a startup where you're like, oh, like it's COVID, I can move to Miami and be remote. Like no, like you have a physical location. You have to be in the store with your employees. You have to greet your, your customers. You have to know your name. Like that stuff matters a lot until you start to like franchise. And so I think that like 10 to 12 hour, 14 hour on your feet day is rough. Right. And then like you gotta want to go home and hang out with your family or your kids or enjoy life. Like it's a tough life that I think I underappreciated. And the last point I would say, the employee base for small businesses is very hard, right? Because this is minimum wage. And so, we would have employees like, I remember we had 8 employees. There was one week where like 5 employees were unavailable, right? Like somebody's like brother was killed, somebody, mother got into the hospital, like all these reasons, which are obviously life, but it's like that compounding effect of like having to constantly turn over your employees, which isn't like the case at startups. I would say, we see 5 to 10% attrition probably a year on average. Like you're seeing like 30-40%, right? And I think like Walmart is like, I think like 40 to 60% attrition on a yearly basis for their store employees. That's like really hard because you're constantly recruiting, constantly retraining, constantly trying to gain trust with your employees, like to like give them more, leverage and to do more so that you can take some off of your plate. And so like that was another thing where I was like, wow, like this is rough.
And in a way, you said about how like a startup, like tech startup, is almost less risk. Do you find moving from angel to venture is almost a similar kind of relationship of, because you're investing in companies that maybe have that potential upside? Like, what do you think was harder in a way, like on your own time and your own?
Yeah, I mean, so angel, obviously you're investing your own money. And so like there is like that like ownership, but like you still feel the ownership as a VC because you won't have a job unless you perform. Right. So I think it's different. I think, for us angel investing, like there was a sense of like, even though we were writing 25K, like when I was 24 years old, like that, like sound like a lot of money. Right now I write $2 million checks. So it's kind of crazy. Like within 5 years, like whatever 40x multiple or, 30x multiple increase. But like, it doesn't feel harder to write that $2 million check versus 25, right? I always tell people as you scale, like your risk tolerance also scales. As an angel investor, one, if you lose, it's your money. So you don't, hopefully you didn't put in too much, so you're okay, because you should assume that whatever you put in, you're going to lose. But then two, like it's much easier to make a 5x for yourself, right? If I put in 25K, like to make 125K is much easier than I have a $100 million fund. I got to make a $500 million return, which means it's probably a $10 billion outcome, right? And so I think just like the scale of like like the bar just goes up so much higher, right? And so like the deals we did as angel investors, like we probably couldn't do as VCs. The deals we did in fund 1, some of them we can do in fund 2, a lot of them we couldn't do in fund 2, right? Because we went from a $40 million fund to $130 million fund. So even if you believe like, hey, outcomes on average are going to be like in some range, if your fund triples, like then you either have to triple your ownership, right, to get the same outcome, or you have to believe that those outcomes are going to grow by 3x. And our belief is not that's the case. So the way that we kind of hedged that was we increase ownership and we increase the number of companies we invested in, right? But you got to balance. I think that's the biggest transition from angel to fund manager. And I would say the last thing, like as an angel, there's no administration, right? It's just like, hey, you're talking to your friends. There's no LP quarterly updates. There's no employees. There's no health insurance, 401ks, quarterly reviews. It's like that aspect is probably 65 to 70% of my job, right? Deals today are probably 25 to 40% of my like day to day. The rest is building the firm brand, talking to LPs, helping the existing portfolio, which you don't typically do as an angel that much. So like, it's just a completely different job, which like I love more because I think you grow and you learn more. But like, there's more stress because like the spectrum of what you do is so much wider than what you do as an angel.
And you mentioned there about LPs, and obviously it's a different relationship, right? Because you're investing other people's money. And raising that first fund, especially with the idea of investing in diverse founders, which, especially when you started, it wasn't particularly popular, and it's getting more popular now.
Not at all.
Still those difficulties there, right? And how did you get that money? How did you get people to believe in what you were doing?
Yeah, I mean, so we raised the first fund. We launched June of 18, so 4 years ago. And this is like pre-George Floyd era, right? So diversity back then essentially was gender-focused funds, right? You had Female Founders Fund, you had BBG, you had, Women Fund, a couple others. Like there was like one or two racially focused funds, but like that wasn't like a thesis or industry that people were willing. So like we would go into meetings like, hey, this is our thesis. 1% of funding at the time went to Black, Latino, and women. They represent 70% of the US population. Today, that 1% is at roughly 3 or 4%. But we're like, hey, like this 1% is extremely focused and extremely niche. Like we don't want to be thesis driven within 1%, right? And people would say, well, what's your thesis? We're like, well, this is our thesis. Our thesis is that diverse founders are going to outperform their 1% of the market. We're going to know this 1% better than anybody else. That was a really hard message, and people like would continue to push. And we were like, at some point we're like, oh, should we do that? And we're like, we don't have a thesis. Like we don't like believe that. Like nobody knew where diverse founders were. Like Crunchbase started tracking race post George Floyd. There was no like we started our own research report, 5 years ago, where we literally would scrub like PitchBook, we would scrub articles and try to find like, hey, where are the Black Latino founders at? And we started making a report. That report last year was roughly 850 founders. When we first started, it was like 105 founders, right? But like nobody actually knew that the statement was like, oh, like diverse founders don't get funded. Okay, cool. But like what cities are they in? What industries are they in? What stage are they at? Like nobody had that information, right? And so like we had to build that information. So I think for us, it was like fund one was really, we were much more agnostic, and we were trying to figure out like, hey, like where do diverse founders exist? Then we realized like, oh, like most of the diverse founders, particularly who are venture backable, are in these like 4 categories, right? So fund 2, we became much more thematic driven. And I would say like 80% of our deals are kind of like in 4 categories, and 20% are still like just in diverse founders. And maybe in fund 3, like that will continue to shift. But like it's been a journey to educate the market. And people really didn't believe that like we couldn't find 30 Black, Latino, or women of all race to invest in. It was like, you do realize there's 360 million people in the country. Like, though we don't have the data because Crunchbase doesn't track it, though we can't show you historical unicorns because people of color weren't getting funded in 2010, so there wouldn't be unicorns today, right? Like, we still like don't think we need that evidence to prove that like there are 30 people of color and women like that deserve a chance to like create unicorns. And it was kind of like mind blowing how hard it was to show that, when like I have friends who are starting funds and like their thesis was like tech will change the world. And it's just like mind blown. Like it's like the most basic thesis of all time, right? But like that, I think that shows the inherent bias that exists in the LP base. And we were fortunate that we found, LPs who took a chance before George Floyd and like really believed in our thesis. And, obviously post George Floyd, it was a much easier raise process. Because people were like, oh, wow, like, yeah, like there really are like racial problems. We're like, yeah, like we've been telling you this for a while. So night and day, fund 1 was 18-month process. Fund 2 was a 5-month process.
And like looking at that as well, what's interesting, I think, is what you said about how there might not be any like Black American founders who've got unicorns at the moment because they weren't getting funded 10 years ago. So you can't use the argument, people diverse founders can't be that successful if they weren't getting that chance to, like, you've got to judge it in say 10 years time or 20 years time when the odds are more even. And I see this a lot of like, why are there no like diverse like CEOs and stuff like that from different backgrounds? But if they're not getting the chance, then how do you expect them to get there? And it's that chicken or egg problem, right? It's like some people are like, oh, it's because they weren't good enough, which is obviously not like fair. And then you get the other side is like, if they get the opportunity, then we can judge that in 10 years time, 20 years time, 30 years time. And that's what's going to be great to see about your fund and the people you've invested in so far, is to see where they get to, right? Because obviously some of them will do really well and then prove the people that didn't back you early on wrong.
I mean, and it's like, and across asset classes, like you can look at, there's been tons of research done by, Harvard and BlackRock and others. Like if you look at like public equities, right? So companies that have women CFOs have outperformed non-companies, right? If you look at hedge fund managers, like diverse hedge fund managers have outperformed non-diverse hedge fund managers. If you look at founders, like diverse founders on average at exit have like a 30% higher like exit chance, right? So like there is data. And I think the reality is like people don't like looking at data, like as much as they say they like track record and yada, yada, like there's a lot of nuances to the game, right? Like whether you're fundraising as a founder, whether you're fundraising as a fund manager, like your brand matters, your resume matters, your references matters, what circles you're in, all these things, like there's, and so I think people put and I was talking to somebody yesterday, one of my friends, about this, because he asked like, hey, how do you prove to people to raise your next fund? Right. And he's one of our interns. And so he's at Stanford Business School. I was like, it's no different than MBA, right? Like everybody's like, oh, like GMAT, right? Like I got a 660 on my GMAT. The average GMAT for HBS is 720. People were like, you should take it again. Like you're not going to get in. I was like, I took this in college 5 years ago. I'm not taking it again. Like, I think I have really good references. I think I have a good essay. I think I have a good story. Like, I'm just going to apply and see what happens, right? The GMAT is one component of like why Harvard's going to choose you, right? Like your references in real life is your resume, right? Your brand is going to be how people view you, how you interview. Do people like feel emotions with you, right? There's no difference from when you're fundraising with LPs.
And what you mentioned there about how diverse founders outperform, I think that goes to show, right? Because they've had to cross a higher hurdle to get to their position than other people have. So if so few women are able to become CFOs, because
they're outstanding because you have to be.
yeah, and that's the thing, right? And it's kind of showing now, like that's almost proof in itself.
And it's annoying, right? Because it's like every minority and woman knows, like your mom tells you as a kid, like you got to be 2 or 3 times better, and it's like that shouldn't really be the case, right? I think from the flip side, when you say that, like if we say this and somebody, that I think the privileged side, which, and, for founder VC would be white men, right, would be like, oh, well, I worked hard too. Right. And so like, I always have like this, this debate with people. And I think I forget who said it. There was a great line of like, white privilege doesn't mean that you don't have challenges. It means your challenges weren't related to your race. Right. And so I think it's like, hey, like, we're not like denying that like you had issues and challenges in life. Right. It's just that like I had challenges because of my race or my gender that you didn't have. Right. And so I think it's like that extra hurdle. And like, yeah, and like there may be like, hey, I'm a Black person, so I have challenges because of my race. But I grew up middle class. Like you were a white person who was poor, so you had challenges because of your income. Right. It's not taken away like that. Like whether like my race was more of an impact than your income. Like I don't know that question. Right. It's just a statement of like, hey, I just know that it wasn't because like that, like I had issues also because of my race. And then like as like my wife, like she has issues because of her race and her gender, right? So it's like an acknowledgement is like, hey, even as a minority, like I know like my position, that I know that like Black women, and I can see it in the data, right, have a harder time raising capital than Black men because they are Black and they're women. Like there's a double, thing. And so I think people get like really emotional about that because people want to feel that like that their story is not getting, subdued. And like their challenges overcome, but it's not really, I think it's not about you. It's just more about like, hey, this is a society and infrastructure that like leads to these challenges for people. And like, it's an acknowledgement, of that. And even like as a Black man, like I acknowledge that for people who are more minority than me to some extent. And as a white person, you should acknowledge that like they're minority and women, or as a man, like that there are those challenges that they have. Like, I'm not saying that like, hey, I'm not smart. Like, I think I'm very smart. Like I got to where I got to because I worked hard. But I also know like there are people who are even like more minority than me that had more challenge than I did to get to wherever they got to.
Yeah. And I think on that point as well, I said, everybody's got different challenges, and like the fund, what you focus on with diverse founders, it should be like the different funds focus on these different challenges, right? So for example, some people who grew up in the projects, it could be whatever race they are, or people who grew up in like very poor. There's all these different disadvantages, and you can't focus on all of them in one fund. But this is why there's opportunity for other people to create funds that focus on other disadvantages, right? And this is what one of the great things about the VC world is that it doesn't need to be that everybody has to think the same. And you can focus on diverse founders.
Even though so much of VC does focus on the same thing.
Yeah, but I think what's changing now is you are seeing these different funds coming about with different ideas and
for sure. People, right? Whether it's solo GPs, whether it's, I was talking to Kickstart Fund, which is a, kind of like Mountain West. They only do Utah, Colorado, and like one other state, right? So geography-based funds, race-based funds, gender-based funds. And what's interesting is like the pushback you'll get for that, right? Like, oh, well, like, why don't you just invest like across the country? Or, oh, like, why don't you just be Black run and like, invest in Black founders, but not only invest in people of color? And like, you do realize that like, you weren't explicitly saying this, but like you were only investing in white men in the Valley. Right? Like now that's changing. It's more, it's more spread out, but like 99%, I mean, the amount of funds that I meet that don't have a Black or Latino founder, like is staggering. Right. Like, I don't think SoftBank, before they launched the SoftBank Opportunity Fund. So SoftBank's main fund, I don't think has one Black founder globally. right? And I don't know how many Latino founders they have outside of the SoftBank LATAM fund, which they just spun out this year. So it's staggering, but it's like you'll get pushback when you try to be, non like what the industry would say, like, oh, like why don't you just like invest in the best founders, right? Meritocracy. And I think like any minority knows that like meritocracy just doesn't exist like in this world. It's just not a reality. I think if you do, you're playing yourself. Like yes, like you have to work hard, but like being the hardest worker does not mean you're going to end up being the CEO or CFO or whatever in any place or get into whatever school. Right. And so I think it's like an acknowledgement of like, hey, like you were already doing this. Now I'm just like telling you to your face, this is what I'm doing. Like whether or not you want to like facade it and say we're investing in SaaS companies that are in San Francisco and 99% happen to be white male. Like I'm just telling you, like this is exactly who I'm investing in.
Yeah. And I think what's interesting about that as well is like, it's also, if you try and invest in everybody, then you don't have a specialism, right? You don't, like if you're investing in diverse founders who've got a similar background to you, you've got some kind of rapport there, right? And people can find that rapport in different ways, right? So let's say somebody is like massive, like they love SaaS and that's all they really care about and they don't really have anything outside of that. Then they're going to connect better with SaaS founders. As if that SaaS VC is trying to invest in a coffee shop, they're not going to know anything, right? And it's sometimes that idea that it's like with anything, right? You have to find that product market fit. And with like the VC, it's finding the right founder fit right as well, right? And if you try and invest in everything, it's not gonna, like you're not gonna understand every single market.
The issue is though, like even if you're a SaaS investor within that, the amount of undiversification is like so unmeritocratic that like it's like, what were you doing? Right? Like, there's no way you can say with a straight face that 70% of the US population is Black, Latino, and women. And if you have a portfolio of 30, that like 3 of your companies, 10% of your portfolio accounts for 70% of the US population. Like, yes, so there's systemic things where like, from a coding or like school, but like, that's just not true. Like women are going to college at way higher rates than men, right? The fastest growing entrepreneurship group in the US is Latinos by far, like 2-3x more than the next group. The fastest population growth is Latinos. And so I think like, it's like, yes, like people, they'll use that as a facade, but like, it's still like, it's not an excuse to say I'm focused on whatever SaaS or, whatever. Like there still are like just systemic things where like your portfolio is abysmal relative to like what it should be, because like we can see like who are the computer science graduates for Stanford and schools. And even let's just take the best schools, Stanford, Harvard, MIT. Even within that, like you're like way under market, let alone like taking non-Ivy League schools. Right. And so I think that's the point that we're at, where people are kind of tired of like hearing these like general excuses of like, we invest in the best founders, but we're venture, so we have to invest in fintech, crypto, Web3, yada, yada. Like there still are like excellent people like building in those subcategories who are not represented in like 90+% of VC portfolios.
Like when you came to start your own fund, did you have that in your mind, like that you're not going to be able to raise money because of your background? Did you think were you expecting that bias, and how did you kind of gain the confidence to do it anyway, even though
we knew it existed, right? I think I underestimated how hard it would be, right? Like, so it took us 18 months to raise 40 million. The first 12 months we raised 12 and a half. The first 6 months we raised 5. So, the first like 6-12 months was like, wow, like we went, we launched in June of 18 when we were in our internship. So we went to New York. We didn't have an internship, so we were just raising. 3 months go by, we get back to campus, we'd raised 3 million. We met with a bunch of people. And so we started recruiting. Like, it was like, it's 2% management fee. There's no way we're going to leave Harvard Business School and make $60,000 total. So $30,000 each. Right. So we were like, okay, I guess like this didn't work. Like, we were like, wow, like and we were grinding. We were meeting people like daily, and we're like, we only raised $3 million, and $3 million sounds like a lot of money, right? But like, it's not, because like you only have $60,000 in management fees, and there are people who raise $3, $5, $8 million funds. They're part time. They're doing consulting, or I think about like Josh Koppelman from First Round Capital. Their first fund was $8 million, but like Josh is like a company public and acquired, right? It's like he already had money. So like you got to know kind of like where you are like in your life cycle. Like we were like, we had deployed $250,000 in angel investing and now had $150,000 of business school debt. So we were not in a place where we were going to be doing that. Right. And so we started recruiting. And then we got our first $1 million check from a billionaire who's one of the like titans of private equity and creators of the industry. And so we went from 3 to 4 million, and like, you go from 60 to 80K management fees, and we're like, this is still not enough, but like, it's sometimes it takes somebody else to believe in you first, right? It's no different than a seed fund or an angel or pre-seed fund, like giving a founder that belief. Whatever we raise, like that's it. Like that's your job for at least 2 to 3 years. So we're like, we need to raise as much money as possible so we can have a real salary and pay off some of the school debt.
And like when you started first finding your founders as well, you said it was difficult to find the founders in the first place, right? So you were scanning like all these different websites to try and find founders to invest in. How hard is it once you started getting going? Were you getting founders applying to you, or where was you getting your deal flow from?
Yeah, I mean, the brand for us has always been super important, right? So it's funny, I just did a tweet today about it. Like we see roughly now 3,000 deals a year. We've grown 1.5 to 2x annually for the last 5 years, right? So our first year angel investing, which was 2016, we saw 60 deals, right? This was like part-time, like we didn't know what we were doing. And then went to like 120, 300, 750, 1.5, and then last 12 months were 3,000. I'm hoping it doesn't go to 6,000 because there's so many deals. But like, it's just been like, it was a slightly still slow pace, right? Like 60 deals was like 5 deals a month. And we were working in private equity. So like this, like we were working 60-hour day weeks anyway, right? So like, that was enough for us, right? And over time, it just started to evolve. And, now that we have a big brand, now that we publish a lot, we have more employees, we have more people focused on sourcing, we're all doing VC calls. That's a part of it. But still today, 70% of our deals come as inbounds, right? So like a lot of our deals do come as inbounds, though like I would say 70% of the deals we do are from network, even though 30% of our deals source our network. So like there is a bias because like people who are sending us deals like know what we like, right? And they know what we're willing to do. But like, yeah, the brand is still a big component. We still do a lot of deals from inbound. And we're always focused on the brand. Like we have a strong belief, like you can't be what you can't see. And so like whether we invest in you or not, I think it's like really important that founders of color, and the same is true for our intern program. We've had 10,000 applicants over the last 3 years, like across 16 classes. Like we want them to believe that like somebody cares about them. Right. I think it's like, hey, we reply to every, deal we get. Like if you do a pitch form, like we tell you why we passed. Right. We provide like a link to like, hey, it's called Open Table, or Open VC, which is a great resource where you can like look up like, hey, I'm pre-seed in fintech based in, London, and it'll show you like the top funds that you should like look for in your category. Right. So I think it's like that, like just that little nods, and people reply to those emails like, thank you for replying. Like, thank you for this resource. I found a fund that invested in me. It's just like somebody cares about me. Right. I think that's really valuable. And I think a lot of people don't feel that. A lot of founders don't feel that way. A lot of people who are trying to get in venture who are of color don't feel that way. So even just like applying to the program, or if they get into the program, we don't give full-time jobs to 90% of our interns. But like we've had 82 interns and 32 now work in venture, right? So we have a pretty high rate of getting interns to other funds. I think like that's just like really valuable, is like building the ecosystem. Because like our belief, no different than a startup, is like we believe the diverse founders are going to outperform over the next 30, 40 years, right? If you go from 3% of funding goes to this population of 70% to 20%, 30%. I mean, if it ever gets to parity, which I don't think it will in my lifetime, 70%, right? If that market grows and we help to grow it, and we're like top 3 in the market, which we think we are a top 3 diverse investor, then you will grow, right? It's no different than whoever, Twilio or Facebook. If social media grows and you're at the top of the platform, like you're gonna grow like Facebook has, even though it's been hurting the last year from the stock market perspective. But I think so like we have a very like startup mentality of like, let's just help to grow the diverse ecosystem, period. We don't care if it's our portfolio, we don't care if you work for us. And if that ecosystem grows and we continue to maintain our brand, like then we will grow as a firm.
And how did you grow that brand right at the start? Like as you were working in private equity, how did you get people to know about Harlem Capital? How did you get people to trust Harlem Capital?
A lot of intentionality, right? Like build the brand, we build the website, we had the cards, we went to events. We try to wear our stuff all the time. We give gear away. You give gear away to our LPs, to our founders. We host a ton of events. It's consistency, right? I think that consistency is the hardest thing, like consistently tweeting, consistently posting, consistently putting reports. Like we literally have a content calendar. And so we know like every week, like we can see weeks out, like exactly like, okay, like we're going to release this podcast, this report. And like people think that we have a PR firm. Like people always reach out to me, yo, like, can you like give me, your PR agency. Like, it's just us. Like it's just like it's a part of like the daily work. Like, we won 2 deals like from Twitter posts. Like, the founders literally said like, hey, like I like this tweet was like one of the reasons I like chose you guys. Right. And so like, I think like people, like, it's a circular effect. Fun too. Now LPs are like, oh, we love your brand. Like, can you like tell us like some of the things that like, like, how did you do this? And some of our LPs are now taking on some of our strategies. Like, the last 5 years, you're now starting to see individuals within firms, right? So Harlem Capital has a brand, but like myself versus Nicole versus Jared, we all have completely different brands, like, individually, right? And we have followers who follow us for different things. And so I think that's been a huge shift the last 5 years, from like a firm view of 2010 to 2015, which is when Andreessen started, definitely, to 2015 to 2020 has been much more of an individual view. And like, we have, I have more followers on my personal accounts than Harlem Capital has on LinkedIn and Twitter, right? Which like 3 years ago was not the case. I think that's just like, that's because of the shift that you're seeing for like what people are looking for from an information standpoint.
Yeah, and it's the thing that we always say, right? The personal brand, because people can relate to you as a person in your story more than they can relate to a company, because none of us are companies, right? We're not businesses. We're all people first, and then we work in businesses or we work on businesses. And I think it's one of the big mistakes a lot of people make. And sometimes even on this podcast, they come on and say, like, the company name did this. We did this. We did this. And it's like, but you need to say about you, because you can tell your own emotion. You can say how you felt. You can give your own feelings. You can't really speak for how your employees feel. And sometimes people say, oh, the team felt this way. But you're speaking for other people's emotions. You can say your own story, and that's really believable and it's really relatable, right? And it's the whole idea, I think, about you want to be relatable rather than necessarily impressive. And a lot of people get that wrong. When you come in here and you be relatable, people want to hear more from you. They want to follow you. If you just shower them a bunch of like, I won this award, I won that award, then sometimes they're like, oh, okay, yeah, cool. That's a robot.
Yeah, it's a balance, right? I think for us, we think about, like, we're very intentional about not naming the firm after ourselves, right? I think it's like we understand the human aspect, because like what my old boss used to say, everything in life is a people's business. I do agree with that. So it's like you have to have a voice, right? But I think if, we're very focused on, I think we're fortunate because we started this when we were 26 and, now I'm 31. Like, I believe that we'll be doing this for the next 30, 40 years. But I'm very focused on like, how do we pass it on? How do we create a legacy? And like, if Harlem Capital doesn't exist after us. And so it is important that like, I am not the reason that people are going to Harlem Capital, right? We always tell people like, hey, like, I'm the partner on your board, I'm the deal, but like, you're getting the full Harlem Capital family, right? Yeah. That's the entire team. That's the founders, the LPs, the interns, yada, yada, like the full ecosystem. And so God forbid, like, even if in the next 2 years something happened to me, like you wouldn't feel like things have changed because you're integrated to the HCP, culture. And so it is a balance, which is like why we're very intentional about doing both. Like, we're like, hey, team, like, go have your view, build your brand, right? Because all of them won't be at Harlem Capital forever. So we want them to succeed regardless of what they're doing, have their brand. But like, we also have to be very intentional, which is largely our platform team. Like, we have to make sure like Harlem Capital also has like a presence, and that people know like, oh, like, that is Harlem Capital.
Yeah, and I think you got it like right there as well in terms of how, so for example, Entrepreneur's Handbook, right? Entrepreneur's Handbook is a brand which is boosted by all the personal brands of like myself, Dave Schools, and Stephen, who've got our own followings. But it does mean that if I was to leave, somebody else could run this podcast, because people understand the brand. And I think sometimes the people aspect is what gets people in the door and gets people engaged. And from there, they then trust the brand. And then once they trust the brand, then you get to meet the other people. So I think that's where it sometimes can help, is that the personal brand helps get people to trust the business brand.
That's true. I mean, I would say most people max probably know 4 or 5 partners at Andreessen, like that they can name, right? Obviously Ben and Mark, and then there's like a few others, but like, they probably have, my guess is like 50 partners or 40 partners now. You can probably name like 10%, 20% max, right? And that's the power of like, there's going to be a few super partners who have that brand, but then that makes you trust the overall brand, even though you don't even know like any of the other partners.
Yeah, exactly. And that's what's interesting about that as well, is that some of those different partners, because they're different specialities, like different people know different partners.
Yeah, different people know different partners.
Yeah, some of them know the crypto focused people, some of them know the other focused people. And that's one of the cool things about it too. But before we go as well, I want to ask you, like, you get so many pitch decks, like you said, and you see these deals all the time. What do you think are the common mistakes that people make when they're trying to pitch you? and like you wish that more founders would think about before they started looking for investment?
So most founders don't even get to the pitch, right? So we see 3,000 deals a year. We take calls with roughly 250, right? So that's 8% of deals that we see we take calls with, which is roughly, one a day. So I'd say to get from that, from the pitch, from the email to an actual call, like your email has to be very succinct. I don't like very long paragraph emails. Like it just kind of shows you can't sell. Your pitch deck has to be designed, not like some Google link and you put it together, in a day. Like if you can't take the energy and effort to, and people have different views on this, right? My view is like, if you can't take the effort to make your brand resonate, then you're not it's the little details that you won't do on a go for it. And no different for us, I think. And for us, because we are so brand focused, brand does matter, right? And we take very seriously everything we put out to any of our LPs, our founders, to the public. So we have that same standard for our founders, right? Now, once you get to the actual call, 250 calls, we do roughly 50 deeper due diligence partner meetings. Right. To get from that to that is usually going to be market fit. So do we like your market? The founder story. What's the vision? Do you have a clear understanding for your customer? We like people who are obsessed with their customers. They do surveys. They, if a customer leaves, they do calls to them to follow up. Why did you leave? How can I improve? Right. That customer obsession is really important, particularly at the early stages. And then who, you as a human culturally, do you fit with us as a firm? Are you a communicator? Do you reply to our emails within 24 to 48 hours, while we're doing diligence, right? Is it pretty clear that you think that we're important for you as your process? VCs can tell where they are in the process, and founders can tell where they are in the VC's process, right? You can tell this is a back burner deal. We're going to get back to the founder late, or you can tell hey, I'm talking to the founder every day, and I want to get this deal done. Founders know that too. They can feel it, right? And VCs can feel it from founders as well. Right. And so I think that level of hey, we really want to work together. We really love work each other. That aspect is also important because it's a long journey. It's if that spark doesn't exist early on, that spark isn't going to exist in 5 years or 5 days or 5 months. So that part's important too.
Yeah. Well, thank you so much for coming on. And where can people find out about you and Harlem? Because obviously you're huge on Twitter and LinkedIn. But can you give people your handles?
Yeah, so H Pierre-Jacques, HPIERREJACQUS for my handles, Harlem.capital for the website. That's where we are. And, we're pretty open. Pitch forms on the website, Harlem.capital/pitch, if you want to apply as a founder or just DM us.
All right, awesome. Thanks so much for coming on.
Thanks for having me.